Is this a groundhog being groomed down in the corner here, Mark?
Well, yes, it is, Ken, and that's actually your engraved invitation to Punxsutawney. Um, they're getting him already. He's 8 days away. We have one more of these sessions before we get underway. So
Well,
we'll be reporting in with 1 day to go. And contrary to rumor floating around out there, I have not personally created all this volatility in the market just to make the groundhog finish more interesting.
yeah, I see you've been accused of that in the forum quite a bit here now. So,
It's not. Well, welcome everybody to the January 25th edition of Bull Sessions. My name is Mark Robertson. I'm joined here by Ken Kavula. He's in a feisty mood today.
feisty, that's a good word. I like that word.
Yeah,
Feisty and malarkey. I'm going to use both of those frequently
he,
going
he
forward.
snuck in a few 40 winks, and he's ready to go. And we are joined here today, not in person, but in spirit, by the wizard. Warren Buffett has taken over the lead in our groundhog standings, so we'll take a look at that. And the Wall Street Bull is down, and as some people have noted, we hope he's just taking a nap. And that's nothing serious. That does kind of resemble our dog Titan laying in the sun, which is a pleasant thing. So it has been a very interesting few days in the stock market. The volatility has been a bit crazy. I would compare it to we were chatting earlier about the NFL game. Well, all four NFL games were decided on the last play of the game this week, the playoffs for the national championships. And a friend of mine called and said, "Well, you heard that the Kansas City Chiefs lost?" I said, "No, they didn't." He said, "What?" They actually had Buffalo had taken the lead with 13 seconds to go, and Kansas City still beat them. So it's that's how crazy it is out there right now. All right, let's get the legal paperwork out of the way. This is an educational demonstration. No investment recommendation is intended. We are here basically to dabble and discuss in the methods, techniques, philosophies, analysis approaches of the modern investment club movement as championed by either the National Association of Investors, now known as Better Investing, or as interpreted by us at Manifest Investing. You will hear opinions from us. We're basically demonstrating that those techniques. Please make your own decision, do your own homework. If we own a company that we're talking about, like I own a little bit of Kohl's, we'll try to disclose that. We do have a roundtable tonight, the January Round Table. And if you'd like to be added to a reminder list via email, please email nkabula1@comcast.net. And our two email addresses are down at the bottom. Please feel free. You are invited to send us topics or questions. We're going to actually take a look at a couple of those today, so you'll see what I mean. We welcome those type of questions and the areas that they nudge us into. Any thoughts, Ken?
No, Natalie gets a lot of mail through the bull sessions here. That's a good thing, by the way. And just if you not only if you would like a link for the roundtable for yourself, but if you have friends that you would like to have them link up, ask them to send an email directly, and we'll add you to our guest list. We're not looking for any affiliations. You don't have to be a member of anything or pay anybody anything to come to the roundtable. But we would like to be able to send you a reminder every month about when to register. I don't know, Mark, did you mention that we put these all on YouTube as well, so that they're archived? So if you can't come in person, then you can come in and watch us at your leisure whenever that happens to be.
We'll actually, when we close this afternoon, we'll show a link that you can look at for YouTube. If you're not familiar with the roundtables, there are many, many months of the roundtable sessions. The only thing I would share with you is that we are simply there sharing ideas. Like Ken said, there is no fee. We should probably change that, Ken, but at least not yet. At least there isn't yet. But no, we're not going to pull a Kramer. And those of you that have followed the investing club know what I'm talking about. We won't do it quite that way, ever.
I I don't know about. I was very disappointed to be a member of that club for what, 4 weeks, 6 weeks, something like that, and suddenly being told that he was going to switch it to a something that had a fee attached to it.
Yeah, and it
So
was a fairly
very
sizable fee.
disappointing.
So no,
Yeah.
we basically share all that stuff. And again, the takeaway is the tracking portfolio has a rate of return of 17.5% over the last 12 years, and that it basically beats the market by about 4 percentage points, 400 basis points. So could be some fun. All right, here's kind of our standing agenda for the bull sessions. Not too much new today because of our session here tonight and the fact that I have been basically away for a couple of weeks. And so we're going to take a look at the groundhog. As always, check in on our best small company to see if anything there needs to be kicked around a bit. We will be continuing with our long-term perspectives on some of our treasured and favorite community favorites in the future. And then those other topics will royal to the top as soon as we get done celebrating groundhogs and that kind of stuff here pretty soon. By the way, I dabbled in the Ethereum last year successfully, Ken, just so I would be able to say that I had done it. So
Right, I remember that. Uh-huh.
and I sold pretty close to the top, and it's now down 50% from where I sold it. So now I'm chomping at the bit maybe to go get back in there, but I have to read that book first.
I don't know, that's burned you before, that second urge. So
Well, yeah,
watch it.
that
Okay.
urge to go back in that type of a situation. Yeah, okay. All right. All right. So I was off last week. Apologize to everybody, but I did have some stuff that I needed to attend to. And so I'm just basically asking the question, what did I miss? Turns out quite a bit. This happens to be from a Disney cartoon that our grandsons watch, Phineas and Ferb or something like that. And just
That's
kind of,
it. It's a great cartoon for adults too, Mark. I'll tell
okay.
you.
Well, obviously with the rhino, these guys are onto something here. And the hint definitely applies. Ken already let the cat out of the bag yesterday afternoon. Was a pretty good year. And I mean, I don't even remember what I was doing. I went somewhere and the market was down like 3 or 4%. And I was happy because Tin Cup was only down a couple of percent. So we're outperforming by a couple percentage points. And I get back at the end of the day and I turn on the screen and the letters are in green. And I figured, well, so I'm hitting refresh. And then I hit refresh and I rebooted my machine. And I'm like, what in the world's going on here? So, Ken, are you taking credit for yesterday's rally?
No, not at all. I was busy doing other things. I was really happy when the market was way down because my two ticker talk stock picks were actually way up yesterday before the market turned around. I had picked IBP, International Building Products, and LND, no, FND, Floor and Decor, FND. I had picked them for ticker talk, and I was getting emails about what a genius I was because I had picked stocks that went counter to the market, and then the market seemed to have caught up. So interesting times, Mark. Interesting
Yeah,
times.
during the depths, I mean, we had half of the positions in the Tin Cup that were actually up, but Amazon took it on the chin pretty hard, a few days ago. And I'm not sure how much they have bounced back yet, but that was noticeable. So yeah, I missed that afternoon, but oh well. It's kind of like that tree falling in the forest. I'm not going to go into the story right now, but I did a session probably 20 years ago with our investment club where we talked about how, an investment club meeting once a month was actually quite a virtue. Because if the stock market went down 8% and then gained it all back 9% by the time of your next meeting, kind of like the tree in the forest, did it actually happen? And there's really a virtue in that, but I'm not going to go too deep into that other than to
Well,
go ahead, Ken.
hasn't Warren Buffett made a virtue mark of talking about his philosophy, which many times is to buy something and then just kind of forget about it for 5 months or 6 months or a year or something because he doesn't want to be bothered with the day-to-day ups and downs?
Well, he definitely talks about what if the stock market were closed and you couldn't make a transaction for 5 years?
Yes, that's exactly what I mean. Yeah.
Yeah.
Hmm.
So the investment club is kind of a kind of faithful to that type of a notion. And anyhow, so anyhow, we got up pretty close to 4.5 million in tin cup. That's why I just wanted to point out the severity here of what's going on, because I'll be darned if we weren't close to 3.6 yesterday morning. And then again, here's last night. This is what one of the screens I was hitting refresh on. We actually gained 2% in tin cup, and the whole market actually gained 5% during the afternoon after lunch. And that makes me a little tired, Ken. We've talked about this before. That's just a little bit rapid and a little bit frothy for me, for my taste. But whatever.
Well, at some point, I think we're going to start to see some of the academics doing some studies about the gamification of trading, and and trying to figure out exactly how much of a game some of this has become. I'm not remembering this type of volatility even in 2008, or even at the end of the tech boom. I'm not remembering days, or at least not very many of them, where you have this kind of a turnaround in a single day. So
Yeah, I mean that's it's a fairly large thing, and when you start stacking it up against 2008, 2009, and what happened a few months ago, they're fairly substantial moves. But anyhow, tree fell in the forest. We're back at 4 million. I think we're probably over 4 million today in tin cup. So whatever. All right, here's
Mark,
one.
Len is asking for the source of the screen, and I'm not sure if he's asking for the source of this screen or the one before it. Can you source the two screens? The cartoon is
Disney.
obviously from Disney,
That is
and then
from Yahoo, Finance Yahoo.
the top of this
Yeah,
page
just
is.
under my portfolio. Same ones that you use for the contests. Don't you see a similar screen like that for your Mid-Michigan stock contest?
I might, but I tend to look just at the portfolios
Summary
rather
screen,
than
right?
the individuals. So you're right. I do see this if I go into the individual portfolios. I
Mm-hmm.
don't dig that deep usually. Right, Len, if that's not answering the question you had, ask a little bit more, okay?
Yep, in that
The
bottom half.
my port, yeah, Len said my portfolios. That's coming from that top is what occurs when you create a portfolio in underneath my Yahoo in the my portfolios section. When you create a portfolio, you get all this other information about the portfolio. uh, Interesting, not always what you would expect, but very interesting.
Yeah, I every once in a while I have tried to take the valuation section that you see here and try to understand what in the world they could be looking at. Because I mean, there are times when we would have, let's say, half the portfolio with fairly attractive projected returns, and it's not reflected here. So I've tried to make rhyme or reason out of it. Uh, it's probably something more short term than I'm used to, because I do notice that now we've got 16 out of 17 in pretty good position, and that happened pretty suddenly.
Yeah,
Whatever.
Mark, do you know what a system they're using for the identification of the different sectors? Is this an S&P system they're using over here? Do you know, or are you just not aware?
I'm not 100% sure. I'd be surprised if it was dramatically different than Morningstar's.
Yeah, I'm guessing that it might be S&P because they're using an S&P comparison over on the performance graphs over there, kind of to the left a little bit.
Mm-hmm.
But remember that every time you change your scheme of stock classification, you change your diversity numbers a little bit to a lot, depending on how different the systems happen to be. Value Line and Morningstar are not identical to each other, and neither is identical to Manifest. I don't think, are they, Mark?
Not exactly. We are closer to Morningstar than Value Line, though.
Right, right.
All right. So here's a look at the value line. We'll spend a little bit more time here in a minute. The thing I wanted to point out, Friday was also quite a day. So when the value line analysts turned in their homework, they basically turned in a return forecast that looked the same as the week before, and the quarter before in this case. And I'm sure that that's probably headed up next week as the lag takes place. I mean, this downdraft that you see here is going to lead to a higher return forecast this week. So again, you're looking at the variability over time. We'll come back to this here in a few minutes when we talk about some more indicators and we answer a question from a subscriber or an audience attendee. All right. Just for kicks, I thought I would throw in just a quick comparison. This actually dovetails a little bit with something we were talking about a couple of weeks ago, Ken, and I actually see kind of a metamorphosis happening in value line. For years, through this entire period, what we observed was that the projected annual return at Manifest, the average or median projected annual return, actually tracked pretty closely to the value line low total return forecast. Now, the populations are a little bit different, the universes, but over time we had observed that. And then something happened, some kind of a downshift. Maybe it's just a seasonal or cyclical type of situation. The value line low total return forecast actually dipped down below, and they've kind of stayed below for the last 7 or 8 years. And I don't know, that may come back because these two had actually aligned pretty well historically, and that hasn't been true for the last few years. And it'd be interesting to watch how that comes home to roost. But right now, the value line low total return forecast, again, that's taking that low total return forecast right off of each individual company page and averaging the 1,700 companies to get that, has actually been running quite low. And I think they have been a little pessimistic in their individual company reports for quite some time. So,
And if you finish that logic chain, because they've been a little pessimistic, that's kind of seeped into the manifest projections or not?
it can disturb them, yeah, absolutely. I mean, we've looked at company after company where the 3 to 5 year forecast is for revenues alone is dramatically less than the 2023 forecast. So, and those have been all ratcheting up. So it's like a kind of a mass ratcheting at value line. We'll be talking more about this in coming weeks. So interesting stuff. All right, here's our inflation moment because I still haven't done my homework. Soon I started. At least I read this tweet, so I get some credit here, right, Ken? Partial credit.
Right.
But I think this tweet actually captures how I feel and or how I have felt. You go back 18 to 24 months ago and you talk about 0% interest rates and then the amount of money that's been moved around by the federal government, and then you mess up supply and demand and you only get 7% inflation. I don't know. Does this rhyme with in any way in what you've been thinking, Ken?
Well, it absolutely, Mark. I'm becoming a little skeptical of where some of this money, this $3 trillion, for example, has actually gone, and how much of it has actually gotten into the economy. I keep hearing about huge chunks of this money that haven't even been basically allocated from the bill yet, let alone distributed. And I know that the bureaucracy takes a long time sometimes to catch up with money that's going out to different populations. So I'm asking myself how much of that has really gone out, and how much of that will never go out. We're still hearing around Michigan here about money that was allocated for emergency COVID relief that has not been distributed to anybody to use. Money that was distributed or that was allocated during the Trump administration is still sitting around, and whether it's sitting at the federal level or at the state level, it really has not been allocated. Meanwhile, our state, for example, is making headlines with huge surpluses in tax revenues that they just never, ever anticipated having. Our coffers in the state of Michigan are full to the brim right now, healthier than they've ever been in the last 10 or a dozen years. So all these figures that are being thrown around with abandon begin to weigh heavy on my mind as to where we're really going with them. And then you put that 7% inflation and you dig down into that number just a little bit, and you find out that a huge piece of that inflation, not by any means all of it, folks. I know there's inflation at the grocery store. I know there's inflation at the gas pump, but the largest piece of inflation is in automobiles, especially used cars. That's a significant piece of the CPI calculation. CPI stands for, help me out, Mark.
Consumer Price Index.
Of course, Consumer Price Index. Okay. So, a lot of this 7%, I just don't see staying around for long periods of time. And then on top of that, they're telling me that I should worry about purchases like boats, because the people that are getting tax relief are buying boats. If you're getting $1,000 extra because you have a child, I just don't think you're turning around and buying a $70,000 boat with that money. I just can't imagine that. I can't tie those two things together. I think a boat is the kind of purchase where if you have to ask how much it costs to run around the lake for an afternoon, then you can't afford it, period. And,
I know who's buying the boats.
well, good. I'm glad. Your son-in-law, for one,
Well,
right?
yeah, him too, but my dentist. My
Okay.
dentist
All right.
actually refers to me as boat payment.
All right. There you go.
Now, one last thought on this, and again, I think I get a little bit concerned on the point-to-point comparisons, and we talked a little bit about this, but some of this is actually driven by energy costs too. And Len Douglas sent an article. I want to take a closer look at it. Maybe we can talk about that in the future also. But you go back and look at, the price of gasoline 18 to 24 months ago was I would argue pretty artificially low. So I mean that has increased rather dramatically from $1.80 to whatever it is, 340, 350. That is a significant contributor to the feeling of inflation in any household. And but keep in mind that it was actually on a trend basis probably a little bit low. Look what it did to the oil, basically the entire energy sector. And that's what Len's article was that he was referencing was about, how that the recovery in that is massive for a number of those companies. So you basically correct for that possibly returning to trend, and maybe the inflation is not quite as bad as people. I mean, again, I'm with you, Ken. You feel it. Obviously, you feel it, but it's quite the mystery.
Well, and Mark, you didn't live through hyperinflation, when you were in a situation where you were purchasing your first home or anything like that. But should we be getting as upset about a total of a point or a point and a half of extra interest in an economy where we're buying the kinds of things we're buying today? I just don't think that extra 1%, 1.5% is going to play into the life of the average person who's not out there trying to put themselves into a home. They're already in a home. They already probably have transportation, and maybe they even have a boat. I don't know, but I think we've become used to belly aching about so much that we're listening to the professional belly achers on TV, and we're starting to believe them.
Yeah, and some of them sit in chairs around the Fed table. So,
Yep.
all right, more to follow. I'll do my homework eventually. All right. Here's a quick look at our best small companies. This was in worse shape a couple of days ago in the morning when I looked to it, almost lost consciousness and decided just to leave it alone. You notice the numbers on the left-hand scale here are dramatically different than the last time you looked at them. Those used to be around 2,100, so they've all gone down, and we're still doing okay. We obviously want to do better than what we're doing, but we're doing okay. And here's my quote from this morning. I just love this one. My wife got this on her cell phone. And our little Irobot vacuum cleaner didn't make it back to its home base last night, so she got a text on her phone asking her if she knew where her Irobot was. So I don't know if you remember the days when it used to be, it's 10:30, do you know where your children are? It used to come on the TV, Ken.
I remember that, but I'm envisioning a cartoon here, Mark, where the iRobot is busily chewing up the last little shoe from a little 3-year-old, you know, kind of macabre, but that's what I'm thinking of here, you know.
Well, it got stuck under our bed in the master bedroom a couple of weeks ago, and I'm like, I hear voices. Because it talks and says, help, help. Oh, anyhow, that comes up because iRobot is our second worst performing stock so far. I'm not concerned about it. It actually has done a little bit better here in recent weeks, and I'm not terribly concerned about Fulgent down at the bottom of the list. It's actually dropped down to minus 21 on a relative return basis. Green Brick Partners actually had a nice bump up to the middle of the group, but pretty happy in general with the entire list still, as long as we don't talk about e-health.
I have Fulgent near the top of one of my lists for next year's groundhogs here, so
Yeah.
I'm not going to open up about what my other picks are, but I really like Fulgent, so I hope that doesn't portend anything really nasty going on in the company.
Well, Boston beer keeps showing up. So, and
Well, it's moved up the list considerably, though, Mark. That Boston beer was sitting down near the bottom of that list for quite a while.
yeah,
So it's almost up to the midpoint now.
yeah, we'll remain hopeful. List is okay. Nothing really to kick around here. Gentherm doing well. So we'll come back and take a closer look next week. All right, so we've got 8 days to go. We'll have one more intra update next week. And lo and behold, Mr. Buffett has actually snuck in there and taken a slight lead over Ruth out of Indianapolis and Nick and George. But Ty Hughes was the one who accused us of generating volatility just to make this exciting. At least one of the people that was accusing us of that. But Mid-Michigan Motors does continue to hang in there. I understand there may be some fur flying between them and the B.I. Baker Club again.
It's not fur, but I think that Mid-Michigan is much more interested in this contest than Baker is, Mark. So, and I think Mid-Michigan would like to hold its top 10 placement. So that's what it's very, very concerned about right now. So we'll have to watch that and make sure it see what happens with it.
Well, they're in position to take the group if unless Space Coast heats up, and they're quite capable of doing that. I do like to point out, I've done this many times, Bauer City out of Janesville, Susan Michelik's club, again on the leaderboard. I think they've been on the leaderboard every year for the last at least 8 years, if not more. And they are a multiple repeat champion in the group category. And the other names, lots of very familiar people on there cheering for you all.
Mark. I'm really liking this strategy that was used last year to come up with the four clubs that I'm involved with to come up with their entries into the Groundhog. We just basically looked at the portfolios for those clubs, um, looked at their dashboards, because each one of these clubs puts their pounce list, the stocks they'd like to own, on their dashboard. And then we picked the top 7 or 8 or 9, or in some cases 6, something like that. But the top stocks off that dashboard, and entered them. And look at how well all four of them are doing in this odd market. If nothing else, I think this is giving kudos to the Manifest dashboard as a nice way of identifying stocks that have some great potential going a year forward.
Yeah, well, maybe we take a closer look at that and a little bit deeper dive, because you're on here too, and again, not to.
I will tell you, my entry didn't use that type uh, uh, of of entry creation, but the four clubs did, and they're all on here with three of them beating the benchmark right now. So that's good.
Yeah, it's been a tough year for us in general. It's one of the weaker performances collectively that we've seen in a while. But the long-term performance of Groundhog Nation is not in any jeopardy. And again, our nod to Kathy Wood. Everybody's beating up on Kathy. She's getting it even more every day. And I just can't believe the perverse animosity that I read in a lot of the financial journalistic press. But she's had a cold year. And
I,
we'll bring
I
it back
think I
in.
used that German word Schadenfreude before, with this feeling that, that's a feeling of secret joy when somebody else is experiencing something bad in their life, and you listen to them interview her on TV, and it's almost as if they're taking and massaging their hands and smiling and grinning to themselves about, you got yours, and this kind of thing. I noticed that she's becoming a little more brittle when she interviews than she was maybe a year ago. She's at the point where she doesn't answer stupid questions anymore.
she's,
So,
she's probably getting worn out. So, all
yeah.
right. The only other thing I'll mention on this is the Barron's Roundtable is underway. So a lot of the input from people like Abby Joe down there at number 34 comes from that roundtable session that's going on right now in the weekend editions of Barron's right now. All right. So here's a little bit of correspondence from one of our favorite people here in the community. And he just wanted to reiterate that, why he's getting involved. And we had actually postulated a few weeks ago, Ken, that less companies made it more likely that you might win a particular year. And that still is kind of shown here, perhaps a little bit less dramatically than it was a few weeks ago. But he makes the point that he really wants to beat the benchmark, and he is. He's in the top 10. And that he really wants to get on the long-term leaderboard, which we'll show in a second. And he's pretty close to that, too. It's 12% annualized return over 5 years. He's basically lagging the market by a little bit, and that includes a couple pretty rough years, as he says, up above. But he's just curious, how should he look at this contest? And his point is that with 10 selections, there's probably going to be less volatility in the results, more consistent performance. And I think that's probably generally true. So kind of a different look. What are your thoughts?
Well, all I can tell you is what I've noticed in our own contest, and I've always worried about sample size when I look at my contest. I guess I worry about sample size even when I look at the Groundhog contest. It's not really that large a sample, but in the Mid-Michigan contest, which ranges anywhere from the low 30s to the low 40s in entries. We've always found that our winning, not always, but almost always found that our winning portfolios come from those people that choose fewer stocks. Now, I don't know if that means that they've just never had a chance to strike out, or if it is that more people choose. I have never made a chart like this one, and maybe that's my next step, Mark, is to make a chart like this particular chart to see if there's just a larger proportion of people choosing fewer stocks, and that therefore you get the winner out of, just by the fact there's a lot more of them than there are of anything else. So
I do think this.
another task to do at a time to be determined. So
Right. I do think this
means
shows
never.
without question that the lower number of stocks does lead to that um, enemy of diversification.
Yeah.
That broad spread on the left hand side versus the right hand side. So again, it's kind of the answer to the question why the clubs have 12 to 20 stocks, and I think you see it right here.
Yep. Yep.
All right, and his question as to how close was he to being on the chart? He's down at a little bit less than his relative return is a little bit below zero. So again, as this year's factors in, probably headed right for the chart somewhere in that range, if not this year, next year perhaps. And what you're looking at here is a number of years participated on the x-axis, and the amount of outperformance on the y-axis. So,
Well, whoever we're talking to, I want to tell you that I spent a lot of years just above and just below the x-axis. So sometimes it takes a little bit of time to move yourself up into a place where you feel a little bit more comfortable in staying. But I think if you can even stay just below the x-axis, you're doing pretty well in this contest.
Ken won't say it directly, but he's headed up and I'm headed down, and that's something that he finds pleasant.
Very pleasant.
So, and here's Bauer City again. So you some of the names you hear a lot around here, but look at Bonnie. Bonnie just crunching away and having a pretty good year again. And again, this kind of underscores this notion that we're not just in this for a year. A number of the entries on here are 10 years or more in churning in results. So
Yeah, is Sandy Castor in this year's contest, Mark?
she is, and she will remain high, but not that high. And we will have a number of, I should make the point, we require that you participate for at least 3 years to qualify for this. So we will have 3 or 4 new entries on here, some of them quite high. One of the fascinating things is we've had a guy that basically hit home runs for 2 straight years. And this year he's near the bottom of this year's list. He's down with Kathy, but he's going to end up on this chart here 8 days from now.
All right.
All right. Here's a quick screen that I'm running as I think about tonight. It's also the type of screen that when the stock market goes down 4.7% before lunch, this is what I think of. And that happened yesterday. And of course, I went by, and we're not going to tell any more hot dog stories, but came pretty close. I basically go looking for companies that have the stock price has been punished, as indicated by their low relative strength. And we have a number of companies below 20, quite an inventory below 30, which is that oversold benchmark. But anytime they get below 20, my ears kind of go up. And I will look at Netflix as a possible stock for the roundtable tonight under the simple premise that the price punishment is just simply too much for what they actually disclosed 3 or 4 days ago. And the analyst consensus obviously agrees with that line of thinking when you look at that type of a number, and a pretty robust number for the year ahead. Morningstar, again, sometimes doesn't keep up very well with the younger companies, the more emerging companies. Same is true for Intuitive Surgical, but these are worth running up the flagpole. United Natural Foods is one that Cy and I had selected for the roundtable. It didn't work out very well, and then after we sold it, it did work out pretty well.
I'm going to guess, Mark, that the yellow backgrounds are just kind of outliers for those particular columns.
Yeah, just the things which make me less interested. I think that the
Okay.
low prove on intuitive surgical, nothing wrong with it. It's just not. It's not a screaming. It's not screaming attractive.
Okay.
And this one here bothered me a whole lot because I wasn't in the original spreadsheet, and then when I updated the data, the analysts are really down longer term on United Natural Foods. So I'd want to dig in a little bit deeper. BlackRock, that's the behemoth. And if I had a number 2, maybe Boston Beer sneaks in there too. I don't know. All right. And then some other quick screening. Some of Ken's favorites show up on this one. This is my ivory screen. Just checking in to see if a company that has a high return forecast and a high quality rating in combination, I call it the ivory soap screen, those two things in combination. And what you find here is 5 or 6 fairly recent selections for the roundtable, along with a few other companies that would have to be audited and verified. But chances are my real company comes off of that list too.
Mark, are we looking at the close of the market yesterday for the prices that come up with these dashboards here?
That would be true for this one, yes.
Okay, because I know Malibu Boats had a wonderful, wonderful day either yesterday or the day before, one of the two.
Okay. That's a recent selection by me and others. Ollie's has been selected recently. Helios came up in some conversations. I don't think DSV will actually survive at that same PE level in an audit, so that's just a question mark. But Boston Beer.
I listened to an interview of the Intel CEO because they're building a huge complex to do chip work to build chips down in very near where I grew up in northeastern Ohio. And you would have thought that ASML was a subsidiary of Intel. He was so high on that particular company. I noticed that it's sitting with a projected PE of 44. But I would urge anybody taking a look at semiconductor equipment to take a look at ASML. He made the statement, this is the CEO of Intel, that you cannot make a sophisticated chip anywhere in the world that doesn't have to go through ASML. They're the ones that have kept Moore's Law alive. You know, Moore's Law said you can put a factor of 10 times as many more chips on a silicon wafer every X years. I think it was at one point it was 4 years, and I think they even cut that a little bit. He says ASML just by itself has extended Moore's Law by about 12 years. They do lithography, printing onto these silicon chips, and they've raised the number of transistors that you can put on the chip. They've raised them by factors of 1,000, not by 10 or 100, but by factors of 1,000. So this technology is evidently just something that you have to have if you're going to make sophisticated chips.
So now I've got some more homework to do before tonight, in case I like that one better. So Facebook, its price has been punished. It's now Meta Platforms. And has that ticker switched to Meta yet or not?
No, it's still FB as far as I know, Mark.
Tencent, of course, is Chinese. I don't think I'm ready yet for that, but it's there. And MKS, Micron, and Maximus are all fairly recent roundtable selections, so those are not new to the party at all. So interesting stuff. All right, here's another question that came across the transom, Ken. I had not noticed this, so we're grateful to Bill Hunt for bringing this to our attention. And he basically sent this in an email that it looked to him like they were making quite a shift in, let's just call it philosophy or global or macro outlook. And he basically came to the conclusion he thinks they're throwing out the old asset allocation model of 60-40 and pointed out that these numbers were, this is from the current edition of Value Line, the investment survey, and this is a number that I don't recall ever seeing a number quite that high before. That's basically suggesting that you have 85% of your investing portfolio in stocks and the other 15% in the same stuff that Nicholson talked about, investment grades and U.S. Treasuries, basically cash equivalents. So that's interesting. And then I went back and looked. In fact, Bill provided a look from just a few months ago, and we basically saw these type of numbers. And I don't know if you had picked up on that, Ken, but here is the actual explanation that I found in the cover story for Selection and Opinion. And they basically owned up that they are kind of switching the way they look at things. And the minimum equity position is now 50% going forward. And maximum 85, call it 85 or 90. And this is quite a shift, and it makes me a little bit worried that we might be at a market top, combined with Jeremy Grantham's latest bubblicious thesis. It's not terribly comfortable to me that they've switched quite this much. A lot of discussion on the 60-40 portfolio, and asset allocation has come under quite a rigorous assault here in recent years. So just it's interesting that this is kind of coming down.
Yeah, this is the kind of information, Mark, that unfortunately I tend to not come across anymore in my transition to the electronic copy of Value Line. With a magazine, no matter what kind of paper it was printed on, I tended to check out most of the pages, and I tended to read articles that I came across that sounded interesting. With the electronic version of Value Line, I tend just to go to the individual company sheets now and don't spend nearly as much time with some of the other stuff as I used to.
Yeah, so I'll give you my interpretation, and it's obviously cursory and a draft or a quick look at it. What they're basically, what I've tried to show here in picture form is, again, the red dots are the aggregate return forecast based on the Value Line median appreciation projection. So that's basically a 3 to 5 year forecast on all of the companies in the book. And you can see that it's basically been hovering near historical lows for quite some time, last several years. And again, those two moments when all of our stock studies basically had stocks in the buy zone up there. But what I've superimposed here is kind of an interpretation of, they basically said that this asset allocation would range from a minimum of 50 up to what I'm going to just round off to 90. So when return forecasts are high, you would basically be up at the 90% range here. And when return forecasts are low, like say for instance, right in this range here, maybe you are at a situation, again, this is very personal. It's not something I really follow too closely myself, but I suppose if I was in an extreme capital preservation mode, had enough assets, maybe I would drift more towards this 50% level. Again, it's a very individual and situation specific consideration from my perspective. But what you're looking at here is basically, what I would expect or how I would expect Value Line to behave. It'll be interesting to see where they go, because if they're starting off at 85%, that's somewhere up here. And that's not really adding up very well for me. I mean, with the Value Line median appreciation projection below 8%, relatively close to historical lows, they're basically starting off at an 85% equity allocation. So I'm just throwing this out there as it kind of makes me scratch my head a little bit. Does that help with the explanation at all, Ken?
Well, I understand what you're saying, Mark, but I'm not convinced yet that 85% ties directly to stock price appreciation. I'm asking myself the question, does some of it tie to the best source of income that you can possibly get? And maybe they're considering that you can't get a certain level of income with bonds, and therefore you need to move more towards stocks, even though they're not producing what they might historically have produced. Uh, Yep, I see that, and it's a short-term gauge, but I'm not certain about the arithmetic yet, so I'm going to have to think this one through, ponder it a little bit.
Yeah,
Uh, yeah,
I think it's definitely a head scratcher, but something we can kind of kick around a little bit and see. I always tend to think of this type of a strategy implementation, using long-term return forecasts. So maybe they are onto something. I mean, those people who jumped out of the stock market 8 days ago are feeling like geniuses right now. I don't know.
Mark, do we have any indication as to what value line might consider to be a good return during a normal year? I mean, okay, they're telling us this allocation, these numbers in these paragraphs here, but what total appreciation should these numbers represent in a normal year? Should they represent a 10% return? Should they represent a 15% return or a 7% return? What should they actually represent when you're all done? That's the number that I'm trying to put into my head to try to figure out where they're coming up with some of this other allocation stuff then.
Yeah, and it gets a little bit tricky. Obviously, not all 2% returns are created equal when the market's minus 20 versus plus 20. I mean, it's one of those situations. The other thing is they've done an awful lot with the shorter term perspective, the 12 to 18 month, and that might be coming into play here. So I think it's just a subject for further study and trying to understand a little bit. But
Yeah, if
it's
we
not.
could get a feel for what their expectations were. I mean, if their expectations are to make 3% a year, then that should, really impact the percentage in stocks and bonds. If their expectations are to make 20% a year, that should impact those percentages as well. And I don't see that final piece of the puzzle sitting there, so I'm not quite sure why their numbers are where they are.
Mhm.
I would think that they have to tie that to what they would like the portfolio to achieve. There has to be a goal.
Yeah, kind of a mysterious blend. So maybe it'll be enlightening as we dig a little bit deeper.
Okay.
All right, since we do have this session tonight, I think we will go ahead and wrap up here. As promised, we do put these sessions, including the
I'm
roundtables.
Mark, I'm going to interrupt you because Ty Hughes goes, wow, the Dow just turned positive, plus 113 points.
Uh,
Crazy volatility.
oh,
Okay.
dare me to look at the real-time groundhog standing. Probably means that Ruth is back in command.
I'm sorry, Mark. Go on ahead
That's all
with the
right. We just want to
YouTube.
remind
Yeah.
everybody that we do archive these sessions, bull sessions, roundtables, and any of our other educational sessions, including the successful investing conferences, of which there have been 4. You can find those at YouTube if you want to check out or sample a roundtable or one of the other sessions. And please subscribe. That way we will let you know anytime new, fresh educational content is added. And I'm going to close with Tonga. That's about a week old, but I just kind of thought that the graphics and stuff coming out of the Pacific were quite fascinating with that underwater volcano. And then in our public service announcement for Herb, I get 2 this week because I missed last week. God's Country will be featuring the Cherry Festival this year, and ZZ Top is coming, Ken, so I think we probably need to put that on our schedule.
which means there'll be a 15-mile traffic jam around the entire city on that particular date. Okay.
Oh, maybe we could get Herb to help us out.
We'll need some help because you'll have to walk to it. It's as simple as that.
All right. So anytime you guys hear us talk about God's country on the round tables, we're talking about Traverse City and that whole area of Michigan, which truly is spectacular. All right. Anything on transom, Ken? Are we good with questions?
Well, one of your friends and my friend, Ann Manning, would like you to check her roundtable, her groundhog contest entry. She says there are prices that are wrong, not stocks, but prices that are wrong. So I'll leave that to you. Okay. And Matt Spielman says essentially Matt says, buy a boat if you want to go to the Cherry Festival.
That is a wonderful idea, Matt. Can we perhaps pursue a partnership opportunity?
There we go. So
All right.
I'll talk to you this evening, Mark.
All right. Thanks, Ken. Take care, everybody. Back to grooming the
Thanks, everybody.